So here are the pros and cons of the various business entity types, like a sole proprietorship or S corporation or C corporation. So when you're starting a business or restructuring one, the entity type you choose has a lot of long-term consequences. It affects how you are taxed. It affects how you pay yourself and how you raise money. It affects your ability to raise money, and it affects how much liability protection that you have. So before we dive in, this content is for informational purposes only and does not constitute legal, financial, or tax advice. Please consult with a CPA. So, and this also clear up a common misconception about an LLC, short for limited liability company, is a legal structure, not a tax classification. That means forming an LLC doesn't mean you're finished. It doesn't automatically determine how your business is taxed. Instead, the IRS lets LLC choose their tax treatment, a sole proprietorship, partnership, S corporation, or C corporation. And that flexibility is really powerful, but it also means you need to understand your options before you file. So let's walk forward through those common structures: sole proprietorship, partnership, S corporation, C corporation, with a focus on both tax and the financial implications. So sole proprietorships, this is the IRS default structure. If you file the LLC and don't file anything, it will kind of default to the sole proprietorship if you're one person. If you're two people, default to partnership. It's simple. It's inexpensive to file because you just put it on your Schedule C of your 1040. That's your personal tax return at the end of the year. You don't need to file a separate business return. From a tax perspective, though, the biggest drawback is the self-employment tax. You pay 15.3% on all of your net income, and that covers the Social Security and Medicare. There's no real way to split your income between the salary and distributions, and so everything is taxed the same. So it depends on how much money you make, right? And how much of a penalty that's going to be versus the higher cost to maintain it. So finally, sole proprietorships are really easy to manage. You don't file all these extra things, but they also do not scale well. You can't really raise capital easily. Investors don't often take sole proprietorships very seriously, and so they might invest not at all or maybe less. And also, if your business is sued or goes into debt, your personal assets are at risk. So I know that a lot of people think that's limited liability. That is it, but the thing is that the line between personal assets and business assets can be really muddled with a LLC sole proprietorship. I've seen it happen a lot where they just kind of mix things. And for freelancers or maybe just a really tiny business, it's okay. But once you really start hiring and taking on some risk, it can cost you really big time. You don't want to lose your personal assets. And also there's a partnership that involves two or more people. It's kind of like a sole proprietorship, but it's more than one person. But like sole proprietorships, a partnership is a pass-through entity, which means the business itself doesn't pay the income tax. Instead, each partner pays that on their personal return. So you'll file Form 1065 and issue K-1s to each partner. The flexibility here is a great benefit. You can allocate income and losses in ways that reflect each partner's contribution, but each partner still pays that self-employment tax on their income. So financial partnerships, partnerships can be really powerful when the partnerships are aligned. You can pool resources, share the risk, and grow faster. But I don't recommend it. I don't recommend them at all. I've seen them go bad a lot of times. They require trust and clear agreements. Disputes over money or reinvestment or just the way they run their business can really derail everything. If one partner should want out, the legal and tax consequences can be kind of messy, and the times that I've heard partnerships go wrong far exceeds when I've seen them go smoothly. Maybe it's just because I hear them more often, but it is just ripe for things to go wrong. People go into partnerships thinking that, hey, I know this guy, or I know this woman. We're friends. We've got history. We go way back. I know them. I know that I can trust them. But the thing is that once money and stress get involved, just like, when they talk about when a parent passes away, partnerships are kind of that way. You find out what people are like under stress, and it's often kind of surprising. People change in ways that you cannot predict, and a partner can really mess you up financially in ways you don't see coming. If they rack up debt or misuse business funds, like not maliciously, but just by not knowing what they should have been doing, or maybe they skip out on their taxes, you could be on the hook, especially in a general partnership where everything's shared. So even if they're not trying to be shady, they just have bad decisions. They make bad decisions, they overspend or they undercharge, and they just ignore maybe the cash flow aspect of it. And they put money here and they don't have the bills to pay something. And then you end up using your personal funds. It can be really, really bad. So sometimes it's just better to maybe set up a different entity type to prevent some of these things from happening. I've seen partnerships where they go into it and then one partner says, I just got to get a job. And they end up getting a job and not working at the partnership. And so the other person's doing everything in the partnership, but the other person is still expecting their half of the profits. So that can happen, or they can do things that damage the reputations. They can do things in their personal life, damage the reputation of the company in the community. So I really hesitate when anybody goes into a partnership. So let's move into some other options. There's an S corp. The S corp is a popular choice for small businesses that really want to reduce their tax liability and increase their liability, or increase their liability protection. It's also a pass-through entity, but the key difference is how you're paid. You're required to take a reasonable salary, which is subject to a payroll tax. But that reasonable salary is a specific definition. I'm going to do a whole video on that because that's a very complex topic. But any remaining profits can be taxed as distributions, which are not subject to the self-employment tax. And that self-employment tax is 15.3%. And that can lead to a lot of significant savings, especially when your business is generating consistent profits. So you'll need to still file the Form 1120S, run payroll, stay compliant with the IRS in your state. But there's also eligibility requirements. You must be a U.S. citizen or a resident and have no more than 100 shareholders and only issue one type of stock. So financially, S corps offer that middle ground. You get the liability protection, you get the tax savings, and the ability to grow. But you also get a lot more administrative work than a sole proprietorship. And you'll need to track your payroll, the quarterly reports, and probably hire a bookkeeper or a CPA firm to stay compliant. So one mistake that I've seen people do is filing the S corp too early. So if your profits really are low or inconsistent, you really don't have the business running. It's good to get the business running first, and because otherwise, the cost of compliance, the cost of payroll of doing the sole proprietorship can kind of hold you back from putting that money into your business. It's best suited for businesses that are established, they have a stable income, and they have owners that really want to optimize their compensation. So then we can move on to C corporations. C corporations is not as much about size as it is about what you're doing with the business. So a C corporation is a separate legal entity, kind of like an S corporation, but it pays its own taxes. It's not the pass-through entity. It pays its own taxes at a rate that really ranges from 18 to 28%. If you take dividends, those taxes are taxed again on your personal return, and that's what people call double taxation. But there's a lot of advantages that C corporations have. They can have retained earnings. It means that you don't have to distribute your profits right away, right? So that can be some tax savings, and also can help your company to grow because you can reinvest that. They also offer better fringe benefits like health insurance, retirement plans, and stock options. And this can be tax deductible to the business. But what is kind of different about C corporations is that there are typically, I've seen them used most often in tech companies or startups that plan to raise capital. Okay, because investors often prefer C corporations. I've seen them invest in S corporations a lot as well. But if they want to have multiple classes of stock and scale easily, they're going to want a C corporation. But for the smaller business that is not really bent on raising all that capital for a more complex reason, or they're not in the tech industry, that double taxation and there's additional complexity with a C corporation that can be kind of a drawback. But regardless, if you do that, you would need to file Form 1120. You would need to maintain a lot of corporate formalities and possibly deal with state level franchise taxes. It's a lot more work, but it does open doors that the other structures don't. So I'm going to kind of summarize this. Choosing the right entity does depend on your income and on your goals and how you plan to grow. Sole proprietors are simple but expensive long term due to the self employment tax, and they lack liability protection. Even an LLC, courts sometimes consider personal assets as business assets. And I did want to put in here that one additional way you can protect yourself, and a lot of people don't, is to make sure you get a business checking account, okay? A business credit card. And don't use your personal assets in the business, even for a sole proprietorship, because that opens you up to liability, kind of mixes and muddies the water between what's your personal asset, what's your business asset, right? So then partnerships, they offer flexibility and shared resources, but they require strong trust in your partner. And oftentimes people change in ways you cannot predict, and this can have devastating consequences on your life. Things that you never had participated in, but they went and did, and it kind of really derailed it. S corporations can you reduce your taxes and offer protection, but only if you're ready for the payroll and all of the other compliance things and the little bit higher cost of preparing your taxes at the end of the year. C corporations are best if you are asking for a lot of investment investors to raise some capital. If you want to have some good benefits as far as the retained earnings, but the double taxation is a big factor. So you probably need, this is not tax advice, you would probably need some tax advice personalized to your situation before you file anything. Changing your structure later can be really complicated, and the tax consequences can last for years. So a CPA can help you weigh the pros and cons and choose the path that fits your business. I will put our contact information in the description below, and you can reach out to us that way. Thank you.